Hi, this is Mark Chandik, and welcome to another episode of Prosperity Perspective. In this video, we'll be talking about how important it is for you to know your investment risk threshold. That's Chapter 3 in my book, 10 Financial Strategies for the Smart Investor. There were several concepts I want to talk about today. First is knowing what your risk threshold is and how to assess it. Second, managing your return expectations. And finally, consider adopting a goals-based investment approach. So let's get started. I like to start the conversation about risk by asking two questions that can be quite revealing about someone's thought process on risk and reward. The first question is, what was the best investment you ever made and why? Second, what was the worst investment you ever made and why? Best investment answers typically revolve around a scenario of luck intervening where a person happens to invest in a particular stock or asset class and there's a big run-up. A great example of that today is what's happening in the tech area. 8 mega stocks are driving that market, and if you own them in high concentration, then you've done extraordinarily well. The answer to the worst investment question is usually more telling because it often involves blaming another person for bad advice. Very rarely does someone want to take responsibility for their worst investment. Most people know that without some level of risk-taking, there is no return. But how much risk, and more importantly, downside exposure or drawdown, can you accept before you lose sleep at night? There are several ways to assess your risk tolerance. First is to use an online questionnaire. These are commonplace in the 401k world, wherein websites assess risk tolerance based on the way you answer questions and then provide you with an asset allocation recommendation. Another way to assess risk and better understand what you can expect from an investment is to look at the expected return and then the standard deviation that comes with the expected return. The standard deviation is a mathematical reflection of the amount of potential upside and downside there is to an investment. In my opinion, understanding the downside or drawdown risk is more important to an investor. Listen, I've never met an investor that doesn't want a high potential upside. But it's the downside that needs to be addressed to determine if the investor can stomach that amount of downturn and if their financial goals can absorb that level of loss. Warren Buffett has said that a 60-40 portfolio mix of stocks and bonds suits many long-term investors. That level of stocks provides a healthy upside potential while the bonds buffer the downside. If you keep adding more stocks to the mix, you increase the return expectation, but you also increase the downside risk. And the sweet spot historically has been the 60-40 mix. It represents the place at which there's diminishing returns if you keep going up in risk. Another great question I ask potential clients is, what is your return expectation? If they answer 10 to 15%, I will then ask, how much downside loss are you willing to accept with that level of return expectation? If they answer 3 to 5%, then they have unreal expectations and we need to discuss this further. If you too have unreal expectations, then when markets get bumpy, you will be caught off guard and unprepared emotionally to be disciplined and patient. Another concept to be aware of is psychological distancing. That means that the further away in time we are from an event, the more we minimize it. For example, after the Great Recession and 37% downturn in the Standard & Poor's 500, that was in 2008 and 2009, investors' thoughts about risk and return were significantly impacted. People took less risk. As time has gone by, and that event is just an old memory, people minimize the impact of that and begin to skew their feelings about risk. This is especially true if we have a long run of positive market performance. Investors need to be diligent that their risk allocation doesn't begin to drift away from their comfort zone. Eventually, markets will turn, and you may experience a deeper drawdown than you were expecting. The final concept is that of goals-based investing. I've done a separate video on this subject. This investment approach moves away from investing in a vacuum and instead focuses on the risk and reward characteristics that support specific life goals. For example, the amount of risk and return you're willing to accept that supports a retirement income goal that is 10 years away may be vastly different than an approach for a bucket of money that will serve as a down payment on a piece of real estate within the next year. By matching the appropriate risk and return characteristics of a portfolio to the underlying goals assures that you're in the sweet spot and that your expectations are in alignment with reality. I hope you've enjoyed this video. Please comment down below and hit the like and subscribe button so you don't miss any future videos. Also, to receive a free copy of my book, 10 Financial Strategies for the Smart Investor, click the link in the video description below. Until the next time, this is Mark Chandik, and thank you for watching.